Hi everyone, and welcome back to my channel. I'm Dean, and I'm back for another video where we break down what's the latest in today's commercial and industrial real estate market. You know what everyone thought was impossible just 5 years ago? Finding affordable industrial real estate anywhere near Toronto. But right now, there's a seismic shift happening in one of Canada's hottest property markets that's creating massive opportunities for smart investors and businesses, and most people are completely missing it. What if I told you there's a region just outside Toronto where you can still get premium industrial space for almost half the price of the city's West End, where vacancy rates are so tight in some areas that landlords are practically turning away tenants, and where major institutional investors are quietly buying up everything they can get their hands on? Welcome to Toronto's East End Industrial Revolution. This isn't just another real estate trend. This is a fundamental reshaping of how Canada's largest economic engine operates, and the implications are staggering. Let me paint you a picture of what's happening right now. The Greater Toronto Area's traditional industrial powerhouses in the west and north have priced out most businesses. We're talking about costs that have pushed companies to make impossible choices: pay the astronomical rents or leave the region entirely. But nature abhors a vacuum, and the market has found its solution in the most unexpected place. The East End, encompassing Pickering, Ajax, Whitby, and Oshawa, has become what industry insiders are calling the GTA's critical release valve. Think of it like this: when a pressure cooker gets too hot, it needs somewhere for that pressure to go. That's exactly what's happening here, except instead of steam, we're talking about billions of dollars in industrial activity. Here's where things get really interesting. While everyone's focused on the average rental price of $14.13 per square foot, the real story is happening in pockets that most people never hear about. Take Thixon Road and Highway 7, for instance. Modern facilities there are commanding $16.50 per square foot. That might sound expensive until you realize comparable space in Toronto's West End would cost you $25 or more. But here's the kicker, and this is where most analysis gets it completely wrong. You can't just look at regional averages and think you understand what's happening. The East End isn't one market. It's four completely different ecosystems operating under the same geographical umbrella. Let me break this down for you. Oshawa is so tight right now that finding available space is like winning the lottery. They're sitting at just 2.5% vacancy. Meanwhile, Ajax has over 13% vacancy, but here's the plot twist. They still absorbed over 600,000 square feet of space last year. What's happening is that Ajax is where the big players go when they need massive footprints with immediate availability, while Oshawa is where you go when you need to be close to everything but availability is almost non-existent. Pickering is the crown jewel, commanding the highest rents at $15.25 per square foot. Why? Two words: operational efficiency. Modern logistics isn't just about having a big warehouse anymore. These facilities need 40-foot clear ceiling heights. That's not a luxury. That's a requirement for maximizing storage density and operational throughput. Without it, you're basically running a business with one hand tied behind your back. Now, here's where this story takes a fascinating turn. The investment market is experiencing something unprecedented. There's essentially 0% availability for sale. Let me repeat that, 0%. When was the last time you heard of any real estate market with literally no inventory available? This scarcity is keeping prices rock solid and creating some truly eye-opening transactions. The benchmark everyone's watching happened in Whitby. A 69,000 square foot trucking terminal on almost 15 acres sold for $3.07 per square foot. Now, that might not sound extraordinary until you understand what they were really buying. This wasn't just a building. It was excess land and specialized trucking infrastructure, two of the most sought-after asset classes in the entire GTA. But here's where the narrative gets really compelling for businesses looking to expand or relocate. The East End just absorbed almost 2 million square feet of new industrial space, with another 900,000 still under construction. This influx has created something we haven't seen in the Toronto market for years: tenant leverage. For the first time in recent memory, landlords are competing aggressively to fill these massive new facilities. Leasing timelines are getting longer, free rent periods are becoming standard, and tenant improvement packages are getting more generous. If you're a business looking for modern industrial space, this is your moment. You can secure world-class infrastructure while locking in favorable long-term economics. The transportation advantages alone make this region irresistible. We're talking about direct access to the 401, 412, 418, and 407 highways. You can service the entire Toronto core, reach Hamilton and Niagara, and connect to Montreal and the eastern provinces, all from one strategic location. Try finding that combination anywhere else in the GTA at these prices. But perhaps the most compelling aspect is the labor pool. Unlike some outlying industrial areas that struggle to attract workers, the East End maintains access to the same skilled workforce that services the entire GTA. Workers can live in affordable communities while accessing jobs that pay Toronto wages. It's a win-win scenario that's driving sustainable demand. Looking ahead to 2026, industry experts predict we'll see a shift toward pre-leased and design-build projects as the speculative development cycle winds down. Rental growth is expected to remain modest, around 3% annually, but here's the key insight. Older facilities are going to face serious pressure as tenants increasingly prioritize modern specifications. This creates a fascinating dynamic. While Class A modern facilities will continue commanding premium rents, older Class B and C properties may actually see effective rents decline as businesses flight to quality. For investors, this means the window for acquiring institutional quality assets at below market basis is closing rapidly. The East End isn't just Toronto's release valve, it's becoming the blueprint for how major metropolitan industrial markets adapt to economic pressures. What we're seeing here will likely be replicated in Vancouver, Montreal, and other major Canadian cities as they face similar cost and availability challenges. The question isn't whether this trend will continue, it's whether you'll position yourself to benefit from it before everyone else catches on. That's a wrap. If you found these insights helpful, make sure to like, subscribe, and share. Comment down below what topics you want us to discuss on our next vlog, and if you want market insights tailored to your specific real estate goals, feel free to reach out to me and my team today. We'd be more than excited to help you find your perfect space to start your 2026 goals. Thanks for tuning in, and I'll see you in the next upload.